Welcome to the Mr. Investor channel. If you're interested in what index funds are, how they work, and whether they're safe to invest in, this is the right video for you. Stay with us and find out all about them. Before the video starts, make sure to subscribe to our channel and press the bell so you don't miss a notification about a new video. Let's start. At the very beginning, we'll explain what index funds are. An index fund is a type of mutual fund whose holdings match or track a particular market index. It's hands-off, and you could build a diversified portfolio earning solid returns using mostly this type of investment. That's because index funds don't try to beat the market or earn higher returns compared with market averages. Instead, these funds try to be the market, buying stocks of every firm listed on an index to mirror the performance of the index as a whole. Index funds can help balance the risk in an investor's portfolio, as market swings tend to be less volatile across an index compared with individual stocks. There are a few key things you need to know about index funds. They're an indirect way to buy the whole market. An index fund buys the securities that make up an entire index. For example, if the index tracks the Standard & Poor's 500, an index of 500 of the largest companies in the United States, the fund buys shares from every company listed on the index or a representative sample of stocks. An investor, in turn, buys shares from the fund whose value will mirror the gains and losses of the index being tracked. By accepting defeat, you win. By picking individual stocks, you're probably not going to outperform the market. Not even the pros do. Research shows that from 2001 to 2016, more than 90% of active fund managers underperformed their benchmark index. So meeting market gains is a surer bet than beating the market, and that's just what index funds are designed to do. Index funds are increasingly popular with investors. According to Morningstar, actively managed mutual funds and exchange-traded funds in the U.S. saw outflows of nearly $514 billion, while passively managed funds saw nearly $1.6 trillion in new money from April 2014 to April 2017. The rise of robo-advisors and passive investing in general have helped fuel interest. See a deeper comparison of index funds and mutual funds here. Index funds are available across a variety of asset classes. Investors can buy funds that focus on companies with small, medium, or large capital values, or focus on a sector like technology or energy. These indexes are perhaps less diversified than the broadest market index, but still more so than if you were to buy stock in a handful of companies within a sector. Also, there are several types of indexes: broad market index funds, market capitalization index funds, international index funds, earnings-based index funds, and bond-based index funds. Since you now know what type of indexes exist, let's see some specific examples of indexes. The S&P 500. It's an index of performance of the 500 largest U.S. public companies. The Dow Jones Industrial Average. This well-known index tracks the 30 largest U.S. firms. NASDAQ. The NASDAQ Composite tracks more than 3,000 technology-related companies. Russell 2000 Index tracks 2,000 smaller companies, also known as small cap, referring to companies with market capitalization of less than $2 billion. The Wilshire 5000 Total Market Index. The Wilshire 5000 tracks the nearly 7,000 publicly traded U.S. companies weighted by capitalization or market size. The MSCI EAFE Index tracks performance of large and mid-cap stocks of a firm based in 21 developed nations outside the U.S. and Canada, including nations in Europe, Australasia, and the Far East. And now you're probably wondering if these indexes are safe to invest in at all. Well, they're not any more unsafe than actively managed investments. The point isn't to compare active and passive strategies, but rather to make sure you understand that index funds aren't necessarily safe investments. You can lose money if investments in the index lose value. Since many of those indices are financial markets, you should expect them to go down from time to time. When you're looking for the safest index funds, you should look for short-term, high-quality bonds. Did you understand the essence of the story? Hope we've explained it to you nicely and that you've learned some new things from watching today's video. Anyway, if you have any questions or just want to share your opinion with us, feel free and write us a comment in the section below. If you haven't yet, then subscribe to our channel and turn on notifications not to miss a new video. Until next time, have a nice day and see you soon.